Hey guys, and welcome to this live session. This is probably the one of the most important sessions I've ever held. I want you guys to be prepared because what I'm about to show you is something we've been waiting for a very long time. We've been waiting to see what will happen here for almost over a year now, and it's getting very serious. Now, for this reason, guys, I want you to put your heads towards what I'm about to play. Please pay attention, guys, to what I'm playing, and then I will describe exactly what is going on, and then we can continue from here.
For now, I believe that policy is well positioned. As always, we are prepared to adjust policy as appropriate to achieve our goals.
Now, before I continue, if you're not too sure what this video is, this is the well-anticipated Jackson Hole Synopsum. I've been talking about it for at least 2 weeks now. And the Synopsum, what it is about, held in Kansas City, is a 3-day event where the Federal Reserve discussed their plans for the future with monetary policy and discuss different issues. Now, the Synopsum always has a main theme to it each year. And this year is about macroeconomics specifically. And so it's a very important time for us to listen to exactly what Mr. Powell is saying. So again, I'm going to press play, listen to this, and look in.
That brings me to a concluding word on the path ahead for monetary policy. The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis. These are challenging times for the public we serve, as the pandemic and its unprecedented toll on health and economic activity linger. But I will end on a positive note. Before the pandemic, we all saw the extraordinary benefits that a strong labor market can deliver to our society. Despite today's challenges, the economy is on a path to just such a labor market, with high levels of employment and participation, broadly shared wage gains, and inflation running close to our price stability goal. Thank you very much.
Okay, guys, those set of words and lines and paragraphs, whatever you want to call them, are the most important thing you need to hear. Now, for you to understand what tapering is, we'll go through it in a moment. I'm going to come back here to the charts just to show you what is going on. All right, so I'm at the charts right now. Let's have a look here. Now, what is actually going on? So the Federal Reserve, okay, first of all, for those of you who are not too sure, is the economic infrastructure for not just the US, but the world, okay, because the dollar is the world reserve currency for the world at the moment. The US dollar, 70% of the world is dollarized, okay? I believe there's about 198 different exchange pairs with the US dollar. The US dollar is the largest by a far margin of currencies that circulates in the world. Now, of course, there's the pound and the euro, but they're a lot smaller in terms of their economic reach compared to the US dollar. Okay. And this is all going back into history when we had, after the war, we had the Bretton Woods system form. Okay. And the US dollar was chosen to be the world reserve currency for the world. All right. So we live in a dollarized world. So what the Federal Reserve say, especially Jerome Powell, who was just speaking now, if you've never seen who that guy is, he is the head of the Federal Reserve. Okay. He's the head honcho, top dog. Okay. And his decisions move the market. Now, what he's just said here, to summarize it very quickly before we go to the technical side of things, is there is the potential, guys, very strong potential for the asset purchases, okay, or OMO, which is open market operations, to decrease. Now, what I will do here is we will go through the price action on Forex, but I will discuss on other terms how this can affect other things. All right. Now I'm going to put some notes here on the side for you guys to just remember what he said. All right. So I'm going to put here Fed notes. All right. So what are the major notes that he said right now? So of course we have the pandemic. Okay. We all know the pandemic. All right. Pandemic. Some people call it a panoramic, but we had a pandemic. Now with the pandemic, what is the major issues that came from the pandemic, which we're discussing here? Now, labor markets or an employment market, okay, is controlled by people. If there aren't people in productivity, now, for an economy to work, guys, let's do some economics here so that you can understand the trade opportunities that are about to happen. All right. So an economy, all right, let's do some economics here. There are things that run an economy, okay, and usually there's three things that we would see going forward inside of an economy. First one is productivity. All right. Productivity is the foundation of an economy to do well. Okay. Productivity produces innovation, and innovation can produce services and products can produce GDP, or the gross domestic product, which is the total value of goods and services within a country within a specific period of time, usually a year. Okay, so that's it, productivity. Now, within an economy, usually there's going to be short-term debt cycles. Okay, now short-term debt cycles are created from the consistent lending and borrowing systems between banks and people, usually. And then we have long-term debt cycles, and these ones happen between 75 years, 50 to 75 years, all right? Long-term debt cycles. Okay. Now, I'm not going to do in a whole economic class, but I just want you guys to understand where we are. Now, with the Federal Reserve, what did the pandemic produce? So I'm going to use a tree diagram for you guys to understand where we are. Now, the pandemic produced a few things, okay? So I'm going to line them up here. So the pandemic, for productivity was hindered because of unemployment, okay? Unemployment. The reason we saw the economy crashing, one of the biggest reasons is because the sharp decrease in employment because of people not being able to work. Now, because of that, we also have something in the short-term debt cycle that happened, which is going to be, all right, I'm going to put this here, loans, all right, defaults. No, I'm going to leave defaults out because that's a more complex topic, but we have loans, okay, lack of money, so people are taking loans out. Asset prices go down. All right. So these are the things that we're seeing. So short-term debt, or debt was created because now people needed money, okay, in order for them to live. Okay. Some people were taking out loans and etc. Okay. Now banks didn't stop giving out loans. They did close because of the pandemic, but they didn't just stop running out of money straight away or anything like that. Now, in the more long-term debt cycle of what we have here, Now, there is a delicate balance when you're in an economy. Now, every economy in the world at the moment, first world, well, not every single one, but the US anyway, is a debt economy. What does that mean? It means it has a debt burden, okay, and it also has an income. I wouldn't want to call it a burden because income isn't a burden. Money's always good, you know what I mean? But anyway, we have income requirements, okay? Now, for if you're not too sure about how this works, I'm just going to quickly do this. Now, I know I'm on a chart here, so it's not really the clearest, but I'll try my best here to use some annotations. Let me grab my annotations right here and give you guys this piece of information. So if I quickly was to do this, imagine, you know, when we used to go to the park, guys, hopefully you've been to the park before to enjoy this. If you haven't, I don't mean to be disrespectful at all, but if you've been, then you know what I'm talking about. So if I was to make a quick seesaw here, all right. Now in the debt economy, on one side, we have debt. I'm just going to call it D for short. Okay. Now that debt, of course, every debt that you have has interest on it. So for example, 2%. Okay. Now, in order for, now this is weighing out the debt burden. Now, the constant buying, every time you buy something, you do something, you've made the transactions. Now, in an economy, all right, there are two ways to be able to pay for something, okay? One way that you could pay for something, and I'm going to use my mouse again, put this over here. Payment. There's two ways. First way is by cash, money, all right? So normal money. In fact, put this here, currency. So you can pay by currency. The other way is you can pay by credit, okay? Credit. Now, in most economies, a lot more of the money is credit than it is actual currency, okay? Now, where does this credit come from? Or where does this come from? So this credit is created by transactions of lending and borrowing, okay? This is where we get a situation of a debt economy. So in a debt economy, all right, companies, people leverage on the fact that if you want to pay for something, let's say you want to buy a car that costs 10,000, if you can't afford it, you can go over to the bank. If your credit score is good enough, then you can get the money, or you can basically get the money given to you, and you can spend more than you earn. Now, because you're spending more than you earn, there's going to be immediately you've created debt and you've created credit too. Now, what does credit mean? It has two sides to it. It becomes an asset, okay, to the lender. So the person that lends you the money, it becomes an asset to them because they know they're going to get their money back, maybe plus, let's say, 10% on top. All right. And then at the same time, when you take out that money, you've created debt. Okay. You've created a liability because now you're going to have to pay. You already didn't have the money to start off with. Okay. And when you take out that money, and especially if you don't use it for productive reasons. So if you take out a loan or take out some money, okay, you want to make sure that that money is going to work to produce more money. Okay. So for example, if you loan money out and you're, into photography, and you need to buy a better camera so you can take better pictures to make more money, then that makes sense. But a lot of what we have in the economy right now is people taking out loans to buy consumables like TVs and cars and things that are depreciating in value. All right. So keep that in your mind. If you want to make a payment, there's two ways: currency or credit. So on the left, we have an asset, because the bank, that debt becomes an asset, that credit becomes an agreement of an asset. Okay. And banks can literally sell a basket of these, which we call the debt market. Okay. And then we have on the right hand side debt, which comes from the person who's borrowing the money. All right. So in an economy, this complete cycle of assets, debt, credit being formed, all right, creates something called a debt burden, okay, or a DB for short. Okay. Now, if you're not too sure what the debt market is, the other term for the debt market is the market of swaps market. Now, as a retail trader, you're not able to get involved in this market. You need to be at the institutional level or higher. Debt can be traded because it is an asset depending on what side you're on. All right. So let's say the debt burden of a country is, let's say 1 billion at 2%. Now, in order for them to overcome this debt burden, or otherwise tip the scale to the right side, then their income or the amount of money coming in, okay, from business, from work, or whatever the country does, has to be greater than 2%. If it's not greater than 2%, then the country is going to be under a debt burden. That's going to cause issues. And this is where we see short-term cycles turn into long-term cycles. Now, another thing that we had here, and I'm going to end off here with our small economics lesson, is money printing. So during the pandemic, the stimmies, so money printing, all right? Or I'll just call it QE for short, money printing. So during the pandemic, we had a lot of money printing, okay? And the reason we had a lot of money printing is to be able to support all of the people who were out of work, made out of work because of the pandemic. They physically couldn't work, okay? Now, again, I'm going to clear all of my, make sure I clear all of this so that it's clear all my drawings, all right? And let's go back to the mouse again. So let's think about this, guys. Now, in the example I just gave you guys of the debt versus the income, in order for the debt burden to be removed and for the country to be in a good place or the economy to a good place, then there needs to be more productivity. Productivity is directly proportional to income. Okay, if you're the more productive you are, the more money you're going to make. Now, if employment goes down, and this is why if you listen to this, the Federal Reserve always talk about target employment or key employment levels in the labor market. What that simply means is that there needs to be a level of productivity to bring in a level of money to overcome the debt burden. That is what their targets are. Okay. So imagine you're a country. Now there's two different types of countries that can exist. Okay. And I'm going to put this here. So there's two types of countries that exist around the world. There's only two: creditor nations, okay, or debitor nations. Okay, so there are nations around the world who are creditors, who lend out money quite frequently to be able to earn a return and possibly muscle in with some infrastructures, namely countries like China. Okay, then there's other countries who are more debtors, who are always taking on foreign debt to be able to invest in internal infrastructure with the hopes that they don't just do it for silly reasons. Well, I hope they don't anyway. But with the hopes that they can use that money to bring more infrastructure into the economy so that they can start to produce their own productivity too. So with money printing, okay, when situations, especially in long-term debt cycles, things happen, all right, and things get crazy, money printing is used as a short-term solution or short to mid-term solution to manage, okay, or offset the risk to the economy as much as possible. Now, what did the Federal Reserve just talk about? Now, I'm saying the Federal Reserve, but it was Jerome Powell anyway, but he speaks on behalf of everyone because they all agree with him. So what we heard from him just right now is that there was something that he said called asset purchases, okay? So if we put the Fed notes over here, maybe I'll put it here, use some space that I have. The first thing he took was about the pandemic. Now, because our unemployment went down, there was more money printing and more loans. It caused there to be an inflation of money. Now, every time you increase the supply of currency in terms of notes or digital currency, all right, it has the potential. Now, hear me clearly. It has the potential, okay, to cause the dollar, in this case, to be weaker, okay, because you've inflated the currency. If there's more supply, it's more common, which means that there's the strength of the currency goes down. Now, hear me out very carefully. Now, in 2008, we had a lot of money printing, but the money didn't get to the public. So if you print out a lot of money, but the supply to the people or the broad supply is very low, then you don't inflate the dollar very much, okay, or you don't inflate the currency very much. But in 2020, because of the nature of the financial crisis that we've been in, the money was not only going to the private sector or to big business and etc., but it was going to the everyday person. Okay, everybody, well, not everyone, but a lot of people are receiving stimulus checks to cover, you know, the losses from the pandemic. Okay, and so that caused the Federal Reserve to turn on their magic machine called the money printer and begin to print out as much money as possible. I believe from 2008, or yeah, I think 25% of all the dollars in existence have existed after 2008. So that we're talking about trillions of dollars of money printing and digital creation of money. Okay. And this was to soften the blow from the pandemic. Now, there are still people, I mean, all around the world, for me in the UK, I hope you can tell by my accent, I am from the UK, from London. All right. Big up all my London people. But anyway, when it comes to the pandemic in this country, we have something called the furlough scheme, which is a way for people to still receive salary, although they're not at work. And this has been running for over a year now to cover the impossible situation of the pandemic, or unavoidable situations of the pandemic. Okay. Now, for that reason, there's always going to be what we call the target employment rate, okay, or target unemployment rate in an economy. Every economy will have different ones, but the reason for this is because they need to make sure that they have enough productivity to make sure that that income rate, okay, is higher than their debt burden. Okay, that's very important. All right. The second thing is when it comes to inflation, the inflation target of 2%, okay, is the aim is to keep the prices of goods and services congruent with employment rate. So they're always going to target for roughly around about 2%. Okay. So the second thing that Mr. Federal Reserve said is something about reduction or even stopping asset purchases. Okay. Not for everything, but for most things. All right. For most assets. Now, what does asset purchases do? All right. Now, without going into the crazy specifics and taking an hour to do this, let me explain. Okay. Now, the price of a goods or service, okay, is, all right, I'm going to put this here, price, all right, is equal to supply versus the demand. Okay. In very simple terms, it's a little bit more complex about how we arrive to the price, but in essence, in the broad spurts of things, price is the difference or the calculation of between supply and demand. Okay. Constantly giving us a price feed. Now, in order for that to happen, now in the pandemic, okay, supply was high, all right, and the demand was low, okay? Low for what? For most assets, okay? If you remember back March 13th to March 16th, if you had a bit of money in your hands, okay, Ethereum, which right now at the moment, where's Ethereum? Do I have it on the chart? Ethereum, if I go to this chart from the monthly, during the pandemic in 2020, one Ethereum was about $80, roughly. $86. You could have bought one Ethereum for $86.20. And from that point, Ethereum's gone all the way to 4,363. So times 10 times about 50 times what you paid for during the pandemic period. So that massive drop right there in price, if you had put $100 in there, you would have had 50K, right? Excuse me, 5K right now. If you had put $1,000, you would have had a 50K worth of Ethereum right now. So as I said to you guys, when it comes to the markets, these are what happens during a financial crisis. All right. Now, what I'm going to do is I'm going to pull back to where we were, and let's continue with this. So where's my charts? Let's grab this to the left. Here we go. Here we go. So when the supply is high and the demand is low, it means that the price goes down. Now, for certain things and certain assets, if the price goes down with it, another thing goes down, and this is important, is going to be treasury yield rates, okay? Or I'm going to put treasury yield rates. All right. Now, US treasuries, okay, treasury yield rates is something that I'm going to just quickly break down. Now, if you want a full description and understanding, I've taught extensively on this on the Wealthy Show channel. All right, it's in the comments below. Find it, the Wealthy Show channel. In here, I talk about the Federal Reserve in deeper detail. But for the moment right now, just to explain it as quickly as possible, all right? If the government, okay, as much as the government, yes, we know that governments can manipulate things. If the government needs more money, they need to get a loan from the Fed, okay? So I'm going to put this right down here. If the government needs more money, the US government needs more money, all right? Then let's put this here. If the US government needs more money, they get a loan from the Fed. Okay. Let me try to see if I can get some words. I'll just put this here. They get a loan from the Federal Reserve. They don't need to, they do it already. All right. So what does that mean? So every time the government creates debt, okay, remember what we said about transactions, somebody is an asset to one side and a debt to another. That asset, okay, created can be sold. And that asset is called a treasury note. Okay. Now, in certain countries, like for example, in the UK, we have a much more posh term called a promissory note, which means the government, in other words, sells their debt to investors worldwide for a certain percentage. So I'm going to put this here, treasury. I hope I'm spelling this right. Note, or just we call this a T note. All right. Another term that probably might be more familiar to you, okay, we call it a T note or government bonds. Okay. So government bonds, okay, are an asset, okay, because it is debt, because you're going to earn an interest on it. And what governments do is when they need more money from the public, whether the local or international public, all right, they can set out government bonds, okay, and those government bonds will have a certain percentage rate that they say that after a certain amount of time, maybe a year, 3 months, 10 years, we will pay you your money back plus interest. Now, each government around the world has different credit ratings depending on how integrous they are at paying back and their economic condition. But this treasury note price, okay, this note price, okay, so I'm going to put here government bond. Let's put this here, government bond price, all right, is governed by supply and demand, okay? And this is done through something called a bond auction, okay? So a bond auction, like you see those shows where they do an auction for a house or for cars and etc. In a sense, is kind of similar, but we have an bond auction, and the government looks for participants to be there who purchase the assets and etc. and etc. Okay, now the government bond price is controlled by supply and demand, and more importantly, the rate of return, I'm going to put this in capital, is also governed by the supply and demand, okay, at the bond auction. All right, so let me put it to you this way. If there is a high supply and a very low demand, then the rate of return isn't going to be that great. Okay, and so what the Federal Reserve do, okay, which is their responsibility. So when you hear him saying our full range of financial tools or monetary policy, this is what he's talking about. Now, the Federal Reserve can't go and take money and start to go and buy like a car or something, or to go and buy stuff for the US. They can only print out money or dish out money, or, okay, that's the only thing that they can do. All right, but in terms of the government, they can take that money and buy military equipment and etc. So what happens here? So to stabilize, and this is important now, last complex thing to look at, the bond yield price, they have to fill any supply or demand, so fill the demand vacuums, okay? So because it's based on supply and demand of actual literal people buying, what the Federal Reserve were talking about in terms of asset purchases is that they fill out the vacuums for demand when the demand is low. Otherwise, the bond price will be bad, and that will affect the US dollar itself, okay, which is even more of a problem. So when he's talking about this reduction of not stopping, but I'm going to change it because stopping is misleading, but just saying a reduction, okay, of asset purchases for most things. Now, the long-term ones, they're not removing just as of yet, but the emergency asset purchases or monthly purchases that the Federal Reserve is doing is to stabilize the price of these treasury notes, okay, so that the yield will be able to be locked in at a certain price. Now, without going into deep details, because if inflation is higher than the treasury notes, then people are not really earning anything in buying power. They're losing in buying power, even though they earn nominally. But that's for another day. If you want to know that, again, the link is in the description below. Check out the wealth wealthy channel. There's an 8-part series about all of these things in deeper detail. All right, so now the fact that this announcement has been made, okay, that the open market operations or OMO is going to be potentially reduced, and with that being said, that means that US dollar tapering is going to happen because the amount of dollars will definitely be reduced also. Okay, now what does this mean for the dollar? Now we've seen the price go long at the moment, spiking long, which means that, especially on gold, if you see the price going long, sometimes it's an anticipation of increased inflation to come. Okay, which is a possibility also. All right. Now, one thing he did say, which is more of a complex thing, but he said that even though there will be, reducing asset purchases, is not going to be a pointer in a sense as to when they're going to start to hike the actual Federal Reserve interest rate or the cost of money or the cost of borrowing. Again, remember, I told you about the market, guys, that we have short-term debt cycles that are created by being able to have credit. Now, when the Federal Reserve interest rate is low or the Fed rate is low, what does that mean? It means that it's cheaper to borrow. Okay, your repayments are lower. Okay, now this is done to fuel the economy, to get people borrowing, okay, and lending so that more productivity can come from it. Okay, from suitable people or people who are able to borrow money. Okay, because that money can go into purchasing assets or it can go into development of business that will increase productivity. So when spending is low, the economy is running slow, interest rates are brought down low. Now, on the other hand, when interest rates, when things are trying to be controlled, the Federal Reserve will hike interest rates to discourage borrowing when the debt burden may be getting too high, or interest rates might be getting too high because the demand is high, a whole load of things. So these are the monetary tools that the Federal Reserve have in their arsenal. And so for him to say what he's saying, that it might not be a point of a rate hike, means that we're still in pandemic-fied situations, but we could be having one of the greatest opportunities for a US dollar reversal or continuation. Now, at the moment, gold is going long. On the sound of the news here, around about 3 o'clock, we've seen a very strong spike. We've had 200 pips already, and the market is almost filled out this pool of liquidity. Now, I have my markings here. I gave this trade out yesterday. So if you've caught it, you should be happy with your profit already. And let's see what the market does. Now, I was expecting it to drop a bit lower, and that's still a possibility. Gold is crazy. All right, but let's have a look at the US. I'm just going to do a very simple analysis here. Let's look at the US dollar index. Okay, now I spoke about it and did some teaching. If you're not too sure what the US dollar index is, please go back and look at yesterday's session. All right, so that you can have an understanding of exactly what that is. Now, let's have a look here and see. So the short has happened, guys, as we said. The price has done the short. All right, and it's starting to sell off. I told you I'm expecting the price to do a short before a long. We're in a very interesting place at the moment, okay, because we're in supply at the moment, major supply. If the price breaks past this area of supply, as I said yesterday, now I don't know why this Fibonacci is extended like this. No pun intended. If you're a trader, you know what I just said. But anyway, it's an inside joke. All right, so anyway, on the weekly time frame here, I'm expecting the price to break past this area at some point. And once it does do that, that would mean that we should be looking at some very strong dollar activity. All right. Now, I told you about the reversal of signature. I've been speaking about the dollar going strongly long, even before there was even talks of tapering. I told you guys, technical price action will show you the true intention of central banks. By the time they're saying it, they've already been deliberating for months in advance. But they have to move the price in certain ways in order to get there. So if you want to have a head start, and in other words, if you want to get into the Federal Reserve meetings without being there, learn how to trade technically and understand technical and analysis from level 2 data and level 1. If you don't know that, I have a free course in the description you can get started with, because it's very important, especially in the times that we are in, to know exactly what's going on. So right now, we're seeing this short-term pullback, which I was expecting, and the price is moving short. At the moment, temporarily, the dollar is losing strength. And I did say yesterday that we are looking for a short. Now, how far can this short go? Now, from the weekly structure, I spoke to you guys about this yesterday. We've had a very strong break past this area of supply that was depressing the price for quite a while. Now, what we haven't had yet is the return back to the other side. So I am looking for, on the dollar index, a 91. So I'm expecting things like USD CHF, USD JPY to take a hike short, but I'm expecting the price to get here. And to be more specific, I'll use the H4. on this one. I was expecting the price to get beneath this low area here and also back into this area of demand. We have a pool of liquidity here, which I believe the market will come for at some point. And this is a very interesting scenario. Now, the Federal Reserve is a very interesting unit, and Mr. Powell is a very intelligent man. And I believe that the way he's spoken, we consider this to be what we call dovish. All right. But I think this is just for the temporal reason to line up with the technicals we're seeing. So I do think things like USD CHF and the others should go short. So speaking about USD CHF, I think I have my markings here already. So let's have a look and see if I have them. Yes, I do. All right, so here we go, guys. So it's happened now. The price has done a very strong short. It's coming back to the order block for reversal that we had, and it's getting around this area here. Now, either the price is going to continue going short, okay, or it's going to come back a little bit higher for us, which I'm hoping for, and fill this area out. But again, I've told you that my short targets for USD CHF for now are going to be back down to this low right here at 0.89645. It could even drop lower, but I'm looking for something around here and then possibly another long. Again, if you're not too sure about the dollar index, watch yesterday's video. So USD CHF is pushing short. Now for Friday, it's quite a strong activity. If you guys have noticed recently, there's been a lot of Friday activity. The weeks have been dry, and then on Friday at a random time at 3 o'clock, well, not random, but at 3 o'clock, the price does what it does. Now, let's see what happens moving forward. I'm not going to do a heavy analysis now. Gold is completely filled with stuff. All right, so AUD/USD, guys, has also done what it needs to. As you can see, it's come back above this area of demand. And if it closes today that way, then we should be seeing the price get back to the redistribution area of liquidity before anything higher than that. So let's see. I'm very poised to see what's happening. My favorite is USD CAD at the moment. USD CAD is still battling between long and short positions, which is cool. Yeah, I told you guys there is a long coming on it. The price has, again, produced a reversal signature at the beginning of the day, and we're seeing the price push long in Asia, which is not the norm, but we will see. The easiest way to get into this, guys, for you to grab a trade is to wait for a break above the H1. If I can give you any advice for now, it would be something of this sort. Now, I'm not going to take the Friday movement as gospel. I want to see what happens on Monday. But with the information you have right now, what are the conclusions? I'm going to give it to you. Well, if I do the conclusions right here, conclusions. All right, to the Fed Synopsum. Yep. So what is the conclusion to the Fed Synopsum? Number one, all right, if OMO or open market operations, or let's just put asset purchases, decrease, it means we have increased market demand, okay? I'm going to put this right up here. Probably need some more space. So I'm going to take this all the way up here and do this. Now, if you've ever used MetaTrader, you know that it's probably one of the most funny softwares to use. Market. All right. Now, this increased demand on the market, what does that actually mean? If there's increased demand on the market, then what we're seeing here is that there will, not that we're out of the pandemic, but it means that the pandemic measures, for example, money printing, is going to be reduced drastically. Okay. Number two, Federal Reserve, number two would be here. Key targets of employment equals to increased productivity. And that means we should have an increase in the GDP. All right. So increase in the GDP, or the value of goods and services, means that the country will be moving towards, okay, more productivity, and the demand increases. All right. We could have potentially, I'm going to put this here, increased interest rates. So we could have potentially increased interest rates. Now, because of the pandemic, guys, you couldn't completely, I'm going to put this, increase interest rates here. Now, the rate hike, the Fed are saying that they do not want to hike the rates until 2023. And it does, of course, depend on the pandemic. But if there's an increase of demand, increase of employment, more people are in work, in order for you to get credit, there's two ways to do it in an economy. Either you're a business person that has a good track record, or you're an employed person that has like 3 months of good paychecks, consistent paychecks, and some other things. So if more money comes into people, more people are going to want to purchase things because more innovation is happening. So that means there's going to be an increase in debt, most likely. All right. Now, that spike in the economy, that increase of demand will achieve probably the targets that, or the first kind of targets that the Federal Reserve have, which means that they soon probably be maybe pushed to even increase interest rates sooner. All right. Now, what does this also mean? All right. The monetary, I'm going to put this here, the pandemic monetary measures. So I'm going to put here QE. Okay. Will be stopped and reversed. This is what I believe. Now that we're coming into this place, if they're going to stop asset purchases, they're also going to stop quantitative easing for a while and look to be going towards the tapering mark. And the reason for the tapering is to keep, a lot of money has gone out to the people. Remember, 2008's financial crisis, there was quantitative easing to bail out big banks and big institutions, but not the people. Many people stayed in unemployment. Many people suffered and haven't recovered from this situation. However, in this pandemic situation, the money printing has gone out to everyone. So there's a broad supply of dollars to the world, which means that there's been we can't see it completely, but there's definitely going to eventually be a stronger weakening of the dollar. Okay. And so this tapering is going to help to manage that or offset that risk. Okay. Because a weakening dollar might cause issues on different markets, for example, commodities markets and things of that nature. All right. So this is where we are right now. Now, what does this mean for trades? All right. I'm going to put this here. So short term, USD trades, USD as in base trades will be short. All right. And then long term, I'll say mid long term, I do think the dollar is going to keep losing value over time eventually because of the system we have of money printing. And since the Federal Reserve was created, we already have a system that's broken. Unless we get back to backing our currencies by gold, which we're not at the moment, every currency that is a currency is going to go to zero one day or very close to. But anyway, I'll say short midterm, then we should be looking for a long on the dollar. That's the tapering dollar. Okay. And if it happens this year, coming into September, which is usually when they do things like this, we should be looking for a crazy long. So let's see what happens, guys.